Hey everybody, Spartan here from SpartanTrading.com. I want to hit you guys with a quick little video, and in this video I want to talk to you specifically about what's going on in the environment. Primarily I want to talk about interest rates and how we can generate trade ideas from the notion that interest rates are going to rise. Now, if interest rates continue to rise, we should expect certain companies to come in or sell off. Now, we need to understand why that does occur. When interest rates rise, that means the cost of borrowing money increases. So if companies are borrowing, or if a company is borrowing a lot of money or has a high amount of debt, the interest on that debt is going to increase, which should affect their negatives from an earning perspective. They're going to have to pay back more money to borrow the same amount that they were currently borrowing, or if they borrow more money in the future, they're going to have to pay back, higher amounts of interest based off of the interest rates rising. So if we can find the companies that have a high amount of debt to equity, then we can assume that they have a higher amount of leverage than its peer or what have you, and they most likely will present higher amounts of risk of holding that equity in this environment. Now, what are some of the names that have high amounts of debt? Well, names that have high amounts of debt can be names that have, or that are basically names that are growth names. You would expect names that don't generate any revenue in the market to have high amounts of debt. They're probably borrowing money to grow, probably borrowing money to expand. And as they do that, borrowing more money, they have to eventually pay back that interest. And if they're doing interest payments, obviously as interest rates rise, it's going to affect their earnings, like I said, from a negative perspective. What's a stock? A stock is a visual representation of the future value of a company, and that's typically based off of their earnings. So if we get higher interest rates rising on companies that borrow more money, those companies should come in. Now, how can we actually scan for them? Well, you can go to FinViz, you can go to the screener, you can go to debt to equity, you can make it, not under one, over one is what we would want to see. So higher amounts of leverage. You could look at companies that don't even have a PE ratio. Basically, what that would mean is they don't have a price to earnings ratio, meaning they're not making any money. So they would have negative cash flow. You can look at basically any company that has a very high PE ratio, and you can assume from there that if based, compared to their peers, the PE ratio is extremely high, the valuation of that company could be high as well, which means it could have room to come in on the downside. So there's a lot of ways of doing this, but the whole idea here is if we want to generate ideas based off of higher interest rates, we need to look at companies that are very leveraged, companies that are borrowing a lot of money, companies that have high amounts of debt, and companies that maybe are not going to be profitable for the next couple years. Those would be the companies with the highest amount of risk. Those would be the companies with the biggest amount of downside. Now, one thing to consider, guys, in this environment as well is we have seen high PE names get smacked. And high PE names getting smacked, for instance, let's take a look at something like UPST, which was at some point, $400 company. Well, had a very high PE tech company, growth name, came in really, on the big time here as they continue to talk about interest rates rising. At some point, it's going to be built in to some extent. Now, if we start to get surprise interest rates rises, or additional hikes that no one's expecting, we would then expect these names to come in more. Now, there's some names that are still very expensive. I think something like Snow, which has a very high PE, just reported earnings, still presents significant risk, I would think, to the downside. So this is something I'd probably keep on my market binder for some downside potential if we start to see weakness. It's a good idea to keep an eye on or build a little bit of a Rolodex of those types of names so that if we start to see surprises with the Fed, you know where to go to. You can refer to your little list there, and you can go after those names pretty quick intraday or on the swing side or what have you. So just a couple thoughts, guys. I think that it's important to understand the situation, important to understand how we can trade around the situation as well, because there's plenty of opportunities to the upside and to the downside going forward. So that's it, guys. Hopefully you guys learned something, or this was useful to you. Otherwise, thanks for watching, and I will talk to you later. Have a good one.